Now, with the Home Mortgage Disclosure Act, this law was created again to give companies and individuals the ability to learn about what is going on in their area. So the Home Mortgage Disclosure Act is also known as Regulation C. It's about disclosing information on a home for the mortgage. Does not prohibit any specific activity of lenders nor establish loan quotas. All it does is says, this is the number of loans we did, this is the statistical information on who we gave the loans to, the racial breakdown, the economic breakdown, and things of that nature. The way I remember this one, at the end of the day, don't you want to see, like Regulation C, your home? Okay, so this is all about making information transparent to the consumer so the customer knows who does this lender lend to and what type of loans are they actually doing. This collects information and publishes that data that can be used to define whether financial institutions are meeting the housing needs of the people in their communities, and are they showing any signs of discriminatory practices. Now, Section 10 of your loan application is called your HMDA section. It's the Information for Government Monitoring. It is that section that is required by law, regardless of whether or not you mark the box, I do not wish to furnish this information. The loan officer is going to furnish it for you, or the person who sat down with you and did the notary, they are going to complete that information for you. It is required by law to be provided to on every single loan application, because without this information, the government cannot detect whether or not discriminatory patterns are taking place. So when it comes to the Home Mortgage Disclosure Act, if a lender says these guys are denied and these guys are approved, and we're going to close these loans, but we're not going to do these loans, you need to have a justifiable reason for that. So what happens is every year, companies are audited and they look at the denials and they look at the approvals. And if it seems like a specific minority, even though their credit and their income qualifications met the rules or the guidelines, they were being denied, or they were being issued rates and fees higher than what this other category was, then what's going to happen is the government's going to look at that and dig a little bit deeper. Is there a discriminatory practice going on? Now, if there's a justifiable reason because of debt or credit problems or other issues along those lines that this group of people did not get the same rates, that's fine. But if really it's apples to apples and this minority group is getting higher rates and payments than this, affluent white group is getting, then there's a discriminatory practice in place and something needs to be done about that. That's what the Home Mortgage Disclosure Act is created for. We are required to disclose certain information as consumers so that the government can detect whether or not any discrimination is occurring. Now, this again applies to pretty much any 1 to 4 family property. What do you mean 1 to 4? Like 4 families can live in it? Well, sort of. A single family residence is considered a 1-unit property. A duplex is considered a 2-unit property. So 2 families could live in each side of that unit. And 4 units, of course, would be like a quadruplex or a fourplex, as they're often called. If it's doing a purchase, a refinance, a home improvement loan, or a subordinate loan, HMDA, or Home Mortgage Disclosure Act, rules always apply. The only time HMDA does not apply to a loan is when it's done on vacant land, new construction, or it is sold as a part of a pool for servicing. So if Chase Bank does $100 million of loans and they sell it off to an investor or to a servicer, they don't need to redisclose that information. It should have been on the applications to begin with. Okay, so it's not like a redisclosure has to happen there or they have to go back and get that information. Data reporting. The Home Mortgage Disclosure Act requires a form called the Loan Application Register, abbreviated as LAR. Okay, so the LAR is required under the Home Mortgage Disclosure Act, and it must be filed every year by March. It will show on this LAR how many loan originations they did, so how many loans did you originate, how many applications they took, how many loan purchases did you do, did you provide any pre-approval programs. or did you have any offers for pre-approvals? So that's all the information, along with a whole lot of other information that we're not going to cover here because we just don't have the time. So again, refer back to your 20-hour materials to make sure you know all the details that are collected on the Loan Application Register, otherwise known as LAR. Now, I promised you earlier that we're going to give you a little organizational chart because certain laws are sub-acts or revisions of acts that had happened before. You are going to be expected to know on your exam which laws fall under which other laws. Makes it complicated, right? Well, the CCPA is really the big first law that was created to protect consumers. CCPA is the Consumer Credit Protection Act. TILA, the Truth in Lending Act, is a part of the CCPA. MEDEA, HOPA, and higher priced loans all fall under the Truth in Lending Act. So if you get a question, something like HOPA revised or modified which larger act, the answer is TILA. If you're asked the question, which one of the following laws is a sub-act of the Consumer Credit Protection Act, and you're going to be given a list of RESPA, TILA, HMDA, or ECOA, the answer is going to be TILA, okay? So the big major law at the top was CCPA. TILA is a part of that, is a sub-act of the Truth in Lending Act, and then MEDEA, Mortgage Disclosure Improvement Act, HOPA, Home Ownership and Equity Protection Act, and higher priced loans, these are a part of TILA, okay? Now, next one, Fair Credit Reporting Act was started in 1968, and the Fair and Accurate Credit Transactions Act came out in 2003. So, Fair Credit Reporting Act is the larger law at the top, and the FACT Act is a part of it. Same thing applies here. We talked about this earlier. The Civil Rights Act came out first in 1866, long time ago, and the Fair Housing Act is a part of it. It's a smaller sub-act that was created in 1968, almost 100 years after the Civil Rights Act was created. And then the last one in this example is HERA. Remember how before I said in order to be safe, you have to have a HERA? Well, a HERA is a girl version of a hero, right? So your HERA, the Housing and Economic Recovery Act, okay, has a sub-act. Actually, it has a lot of sub-acts, but in this example for the mortgage industry, it's the SAFE Act, which is the Secure and Fair Enforcement Act. All right, and congratulations, you have now completed your federal mortgage law section. Now we're going to move on to general mortgage knowledge. What is general mortgage knowledge? Well, general mortgage knowledge is, do you know and understand the language of the mortgage industry, the definitions and the terms, but also, do you know and understand the programs and the products? So we're going to get into all of that right now. So first off, conventional loans. What did we say earlier when we were first starting off with our, things that you needed to remember? Conventional. Anything other than a government loan. That's going to fall into the conventional category. Can be done by any party of the mortgage industry. If it's not insured by FHA, VA, or USDA, that loan is a conventional loan. Again, not insured by a government entity. It's usually guaranteed or purchased in the secondary market, but does not have to be. Secondary market is basically Fannie Mae and Freddie Mac. They buy the closed loan from banks and other mortgage institutions so that those banks and other mortgage institutions can continue to use their money to fund more loans so that it keeps the marketplace moving. But you don't have to sell off your loan to any investor or any organization. You can hold on to it, which is called portfolio. So Bank of America probably hangs on to some of their loans. Your major financial institutions will. So when they hang on to it themselves and service it themselves, they would be that would be called a portfolio loan. All right. Most of the time, your conventional loans are going to be long-term, fully amortized, and fixed rate. Now, loan to value ratio. First off, you need to know the term loan to value. It is a percentage, and it's what percentage of a loan do you have as it relates to the value of your home. Now remember, value is kind of a loose term. Value means the purchase price or the appraised value, whichever one is less. Okay, so if I have a $100,000 value and my loan amount is $80,000, my loan to value is 80%. You take the loan amount divided by the appraised value or the purchase price, whichever one is less, that equals your loan to value. All right, so again, that's exactly what I was just explaining. Again, one of the great things about this video is you can just pause me, read the slides, rewind, listen to me explain it again, and follow along. Now again, with lower loan to values, those are less risk. Lenders don't require mortgage insurance. Anything over that 80% mark, you're going to be requested to have, or you're probably going to be required to have mortgage insurance. Don't even see too many 100% loans anymore unless they're through VA. They're very aggressive that way. Private mortgage insurance we talked about earlier. If the loan to value is higher than 80%, then you will be required to have mortgage insurance. You can pay one fee at closing and that'll cover your insurance for the whole time. You can do, I'm sorry, that's your one-time PMI. You can do a partial payment at the beginning and then continued payments for the rest of your term. Or you can do what's called lender paid mortgage insurance, which is LPMI. And that one would be where you have a slightly higher interest rate so that it is tax deductible and they will pay the mortgage insurance for you. All right. Homeowners Protection Act, which we referred to earlier, says you have the right to request removal of your mortgage insurance when your loan to value reaches 80% based on principal reduction, and it's automatically required to be removed when it reaches 78%. Now, non-conforming loans we talked about earlier. Non-conforming is like a jumbo loan. In order to be conforming, you have to fit Fannie Mae, Freddie Mac guidelines and have a loan amount of $417,000 or less. If you are outside of either of those categories, then you are going to be considered non-conforming. So if your loan meets Fannie Mae, Freddie Mac guidelines, but it's over $417,000, you're still going to be a non-conforming loan. All right, so it does not meet the standards of Fannie and Freddie, the size of the limits. Again, some areas have higher limits, but for sake of the exam, 417 is the cutoff for conforming. Credit qualifying of borrowers may not meet the standards. Maybe you have the perfect credit score, but maybe you are lacking in the debt ratio. Your debt ratio is too high to be considered a Fannie Mae, Freddie Mac loan. So even though your credit's perfect, and your income's good, but you have a lot of debt, it's going to throw you out of conforming and put you into the non-conforming category. Interagency guidelines. This is guidelines that was given by 5 government agencies to try and give direction or guidance on loans that fit into that non-traditional category. All right, so the loans that don't really fit the Fannie Mae, Freddie Mac mold. Okay, this statement was issued in 2007 and it was given guidance on non-traditional mortgage products. What again is non-traditional mortgage products? Anything other than the 30-year fixed. This law, or I'm sorry, the interagency guidance or this statement was issued by these 5 government agencies. You're gonna love the way to remember this one. Are you ready? The 5 government agencies that wrote the interagency guidelines or gave the statement on interagency guidelines was the buffoons. B for Board of Governors of the Federal Reserve System, F for the FDIC, O for the Office of the Comptroller of the Currency, O for Office of Thrift Supervision, and the National Credit Union Administration. So on your exam, when they ask who created the interagency guidelines, the buffoons did, and hopefully that's an easy way for you to remember it. All right, subprime loans, you really don't even see too many of these anymore. They kind of went away in 2008 with the crash. They'll probably squeak and ease their way back into the marketplace at some point in life, but a lot of people were damaged by subprime. Doesn't mean they had bad credit necessarily. It just means they didn't fit the qualifying parameters of Fannie Mae or Freddie Mac. So these loans would typically allow for more risks in the marketplace, but today not a lot of lenders are comfortable with those additional risks. So a lot of companies don't even do them anymore. And like I said, all your subprime mortgage companies pretty much went out of business. These are also referred to as B or C loans. The prime market or your Fannie Mae, Freddie Mac stuff, that was called the A paper market. Anything that didn't fit into that A paper category was considered B and C loans. All right, so they would have this subprime or this B lending market. These have a lot of criteria that varies across the board. The problem in our mortgage industry is when the crash happened or before the crash happened, companies were really getting loose with their guidelines. They would do 100% financing with super low credit scores and super high debt ratios, or they would not require any income documentation whatsoever. And they'd stockpile all of these different risk features on top of each other. Any one risk isn't any real big deal, but when you start compiling them all together, you've got a really high risk loan. And that's why they've pretty much been eliminated from the marketplace. Also, there were certain characteristics. A-paper loans were typically your 30-year fixed rate mortgages. Today, we've got a lot more variance and a bigger scope of what type of loans we can do, even for an A-paper borrower, and that's where we get ARMs. ARMs are adjustable rate mortgages. Your rate is going to be changing over a period of time. They usually have what's called a low introductory rate. This was what used to be called they're still called your hybrid loans, but what happened historically was we had a 2-year fixed rate loan, or a 3-year fixed rate loan, or a 5-year fixed rate loan. People didn't hear the 5-year part. They heard the fixed rate part. So when you've got a borrower who hears a 5-year fixed, they hear fixed, they think their loan's fixed for the entire term of their loan. And it wasn't. The rate was fixed for 5 years. After that, it would adjust, and they may not be able to afford that adjustment when it occurred, which is why today more disclosures are required, and there's certain direction and guidance that's given under the subprime or the ARM category. Again, these have high or no limits on the increases of what could happen after the rate had adjusted. They had low or no documentation loans. They had features that were likely to result in frequent refinancing, which we call today churning. So I've got my 2-year fixed borrower. You can't even say that anymore. If you do, you're in violation of TILA. You need to say your 2-year ARM. So that way there's no misconception of what fixed actually means. On a 2-year ARM, as you see here, your rate's going to adjust after the second year. Well, that would create that dynamic of constant refinancing, because every 2 years when the rate changes and likely goes up, your borrower is going to want to refinance out of it to keep their payments steady and in the same level. So a lot of companies or a lot of people would refinance out of their short-term ARM. Hopefully they had fixed their credit problem or whatever issue they had that kicked them out of Fannie and Freddie or your conforming category. But if they didn't, then they're just going to continue with this vicious cycle. All right, substantial or extended prepayment penalties. That was a very big common characteristic in the subprime industry. All right, mortgage lending again urges customers to be aware of payment shock. When the rate changes, will you be able to afford the payment? Yes, it's 2, 3, 5 years down the road. Use some common sense and look at that payment and decide if you think you're going to be comfortable with it when it occurs, barring no craziness happen, you didn't lose your job or anything like that. Prepayment penalties. How is it calculated? How much is it going to be? What exactly does it mean? Well, I've said before, prepayment penalty is 6 months of interest on the remaining principal. So let's say our loan balance, again for easy math, is $100,000. You've got a 2-year prepayment penalty and rates have really gone down, and you're 18 months into the 2-year prepayment penalty. You have 6 months to go before you can refinance and not be charged that penalty. If you refinance 1 day before the 2 years or 18 months before the 2 years, you're still going to pay the prepayment penalty. So it's 6 months of interest. So if the interest rate is, let's say, 3%, that's super low, not realistic, but humor me anyway. So 100,000 times 3%, that equals $3,000. $3,000 divided by 2. Why divided by 2? $3,000 is your annual interest, right? Annual interest is 3%. So 100,000 times 3% is 3,000 divided by 2. If you want to pay your loan off before the 2-year mark, you will have to pay a penalty of $1,500. And that's what, CFPB and the government wants us to be aware of now as consumers. Do I know and understand what that means, and am I willing to take that risk? All right, balloon payments, again, we talked about that before, when you're gonna have to pay off the full loan before the end of the term of the loan, like a 30 due in 15, very common. Cost of reduced documentation loans. This would be your willingness to pay a higher rate or higher costs to get the loan because you are not providing income documentation. I'm not providing any W-2s, no pay stubs, no tax returns. You're just gonna do my loan by what was called either no income or stated income. And you were willing to do this, but it's gonna cost you more, higher rates or higher fees. Now, if that's a trade-off you're willing to accept, go ahead. But there was a cost, and now you have to advise the borrower you're paying more to not show your documentation. All right. Also, one very common characteristic in the mortgage industry was, again, I do mean this as historical, not really today, but borrowers would often do a refinance on their loan or even a purchase, and they weren't told that they were responsible for the taxes and the insurance on their own. They thought that their monthly mortgage payment paid to whoever their bank was including taxes and insurance. Oftentimes it wasn't. So the tax bill comes due once or twice a year, it varies state to state, and all of a sudden they have this big fat tax bill due, and the customer's like, wait a minute, this is paid through my mortgage loan. No, it's not. So that's something, again, you need to make sure you're aware of. Do I know what is paid, and quite frankly, who pays it? Ultimately, you pay it. It's just where and how you pay it. So that was a common characteristic that people would do. And what do you think those crooked loan officers were doing in this case? They were, again, churning. Oh, Mr. Borrower, you're behind on your taxes. I'm really sorry to hear that. I can refinance you, take the equity out of your home, and pay those taxes for you. And then oftentimes they would do the same thing, not put them into an escrowed or an impounded account, and the same thing happens next year, and that creates this vicious cycle of refinancing, refinancing, refinancing. All right, now for non-traditional mortgage products. Again, this is what let me try that again. The description of what you see here is that or negative amortization thing I demonstrated for you earlier. Mortgage products that allow borrowers to defer and sometimes defer principal and sometimes interest on their loan. So again, that's a risky feature. Your principal is going up, and if your value is going down, that's going to become a problem. They outline prudent underwriting and consumer protection principles, things like collateral dependent loans. This is a loan term that relies on the sale of a property or refinancing once the amortization begins. So a collateral dependent loan is, you've got your home, it's a sellable asset in the event you can't make your payments. As long as value is there and equity is there, you can always sell the house and get out of your loan. But those are very dangerous when you're counting on the collateral to pay off the debt, because if the value of the collateral goes down, now you're upside down and in a real pickle. Risk layering, I talked to you about that before. Low credit scores, bad credit, high debt ratios, not proving income, risk, and we were just piling it all on top of each other. Reduced documentation, you have higher prices in order to do those types of loans. A first and a second mortgage, so you have no room for equity. Introductory interest rates, these are your hybrid loans, ones that have a rate that changes later on down the road. Now, government loans do have a tendency to be more conservative. However, VA is really an exception to that. When it comes to VA or FHA or USDA loans, they are not a loan done by the government. You go to any mortgage institution to do a VA, FHA, or USDA loan. It's who's insuring it. Remember that private mortgage insurance? Well, this is government insurance. So government loans would be, you get a loan from Wells Fargo and FHA is going to insure it, okay? That would be considered an FHA loan. Again, don't confuse that with secondary markets. Fannie and Freddie are secondary markets. You sell your loan to Fannie or Freddie. VA, FHA, or USDA, they're that insurance company. They're the one that's providing the banks with the insurance that if your borrower defaults, we're going to pay you back some of it through the insurance so that you can sell off your loans and, again, recover some of the loss. The most common ones are the ones that I've just mentioned. Sometimes these are called rural development, but really what we're referring to is USDA, the United States Department of Agriculture. Now, there's lots of loan products in our mortgage industry. Fixed rate mortgages, there's really no bells and whistles. Here's your rate, here's the payment. You are going to have this rate and have this payment for 30 years. Now, you might have a shorter term, like a 15-year fixed. Again, here's your rate, here's your payment, pay it over the next 15 years. ARMs, however, are a far bigger animal. Lots of bells and whistles and ways to do it, and different margins, different indexes. Every company does these a little bit differently. So when it comes to an ARM, there's lots of different pieces and moving parts. First off, you have what's called an index, okay? The index would be what is the loan attached to. That's this variable factor. So one of the most common ones is the TCM, the Treasury Constant Maturity. You don't see too much about coffee anymore, but that's the cost of funds index. LIBOR is a very common index you see today. That stands for London Interbank Offering Rate, and the 10-year Treasury bill. Now, there are definitely other indexes, the monthly Treasury average, that's already up there, COSI, which is the cost of savings index. So there are many other indexes, but these are your most common ones. Now you've got a margin. The margin is added to the index, and that's going to determine your interest rate. Then you've got a rate adjustment period. When is my rate going to adjust, which coincides with when is my payment going to adjust. Interest rate caps. How much can a rate increase or possibly even decrease at each adjustment period? Mortgage payment caps again, when can they change and how much can they change? And negative amortization caps, how much interest can I defer before I'm no longer allowed to defer? Now, when it comes to adjustable rate mortgages, they can be very, very complicated. So let me show you an example of how indexes and margins take place. And this is when you're probably going to want to rewind a couple of times because it can be a little bit tricky. Just a lot of moving parts. All right. All of your mortgage loans start off, or all of your ARMs, start off with an interest rate. Let's say our interest rate is 4%. All right, all ARMs have an index. Actually, I'm going to do this differently. All right, all ARMs have a margin that is set by the lender and it will not change. Let's say in this example, the margin is 2. All right, and all ARMs have an index. Let's say our index at this point in time is 1%. All right, let's say it's LIBOR. LIBOR is 1%. Now, let's say that this is a 2-year ARM. 2-year ARM. It means my rate's going to stay at 4% for the first 2 years. After that, we're going to look at what the index is. Indexes generally change over time. They don't always stay the same. So let's say at closing, my index was 1%, but 2 years later, it's now moved to 2%. Okay? Actually, that looks like a Z. We'll change it. All right, 2% on the index. Now, what is your rate going to adjust to on the 25th month or the beginning of your second year? Actually, the beginning of your third year, sorry. So first off, you can't determine what this rate is going to go to yet because we don't know what our caps are. Now, all ARMs have either 2 or 3 caps. Let's say our caps is 2 and 5, okay? This means each and every time the rate adjusts, it will not adjust by more than 2%. And over the entire life of the loan, it will never adjust to more than 5%. So all in all, you'll never have a loan that is higher than 9%. But 9% is a far cry from 4%, so that's what you want to be leery of. Okay, now you are going to adjust to one of two things. The margin and the index added together, which equals your fully indexed rate. And I'll write that out for you. Fully indexed rate. Okay? The fully indexed rate is what you get when you add the margin and the index together. But you may not adjust to the margin and the index added together. So in this example, hey, you got lucky. Your adjustment for that third year, or month 25 for the next, till month 30, 12, 24, 36, yeah, to month 36 is going to be 4%. So you stayed the same because you got lucky. But let's say, I don't know, the index just goes nutsoid, okay? And now your index is 10. I don't think I've ever seen that much of a change in such a short time frame, but it could happen. So now my fully indexed rate is 12. Am I going to go from 4% to the new indexed rate of 12? No, that's what we call payment shock. People can't make that when they're used to making a 4%. That's why the caps are in place. So if your fully indexed rate is more than 2% over what you were last time, then you are going to go up by 2%. So you're going to go from 4 to 6. Now let's say, for example, that index stayed the same the next year. Index stayed at 12. If that's the case, you're not going to go from 6 to 8, right? I'm sorry, you're not going to go from 6 to 12. You're going to be limited to 2% over. So 2, again, higher than what you were. Actually, let me do this. 2, so 6, you're now going to go to 8, only 2 over, right? But then the next year, let's say that, again, margin and index stayed the same, or index stayed the same. You're still at 12% on your fully indexed rate. Are you going to go from 8 to 12? No, you're limited by 2%, right? No, not by 2% this time, because your maximum rate you will ever be is the last number in your caps plus your start rate, okay? That's going to be 9%. So you're not going to go from 8 to 12 or 8 to 10. You're going to go to 9 because that's what is called your maximum capped rate. You will never, ever, ever be higher than your fully indexed rate or your capped rate, whichever one is less. Okay? So the first example, when we were at 4 between these two, you're not going to adjust 2 over because the margin in the index was lower. Now when the index goes higher, your fully indexed rate is higher, well then you're limited to the caps of you're limited to what the caps would put you at. Now, there's one other way that you might see this, and it's a 3-part cap. So all the same rules apply. We'll do similar numbers. Rate of 4% for 2 years, your margin is 2. Let's say your index is 4, okay? In this example, you've got a 3-part cap. Let's say it's 3, 2, and 5, okay? This means the very first time you adjust, you will not adjust more than 3% over what you started. Every adjustment after that, you will not adjust to more than 2% over what you were at the last rate, or at the last time. And then over the entire life of the loan, you will never, ever, ever be more than 5% over what you started, okay? This one here only applies the very first adjustment after it's been fixed, okay? So you're fixed for 2 years at 4%. Now we've got a 6% fully indexed rate. Am I going to go from 4% to 6% because that's what my fully indexed rate is? I don't know. Let's look at 3. Our first adjustment cannot be more than 3% over what I started. Well, that would have put me at 7%, and this one no longer applies now. Now again, let's say index went absolutely nutsoid and we're at 14 now, which puts my fully indexed rate at 16%. Am I going to go from 6 to 16? No, that's absolutely insane, right? So what you're going to do is now look at 2 over your start rate. That's going to put you at 2 over what your last interest rate was. That's going to put you at 8%. Next time, am I going to go up 2% to 10? No. Why not? Because the 5 and the 4 equal 9. I will never, ever, ever be more than 9%. So I'm not going to go from 8 to 10. I'm going to go from 8 to 9. Okay? Again, you might need to watch that a couple of times because that can get a little bit complicated and it's a lot of information. Now, when it comes to provisions under ARMs, things that you need to look at. Periodic reamortization. This would be, again, a characteristic of the old, I was going to say reverse mortgages, but the old negative amortizations. And if you got to a point where you could no longer defer, they would re-amortize your loan, look at your new principal balance, and which includes all that past deferred interest, and they're going to spread your loan out over the remaining term, and that's the new required payment that you'd have to make. That's called re-amortization. Convertible ARMs. These were loans that started off as an ARM, but for a certain period of time, usually within the first 5 years, for a small fee, you could convert your ARM to a fixed rate loan. You usually had to wait at least 1 year, so be in the ARM for at least 1 year, and then you could convert it. You don't see them too terribly often anymore. It was a characteristic of a very common Freddie Mac product, but that again is a convertible ARM. Now, ARM disclosures, again, are required under the Truth in Lending Act. You have to give the CHARM booklet, which stands for Consumer Handbook on Adjustable Rate Mortgages, along with the APR disclosure, which is either going to show up on the Truth in Lending disclosure or on the TRID, depending on what type of loan you're doing. And you have to give advance notice of any change in the payment or the interest, so that way the borrower has time to refinance, sell the house, so they don't get hit with this big payment and not be able to afford it. All right, pay option ARM was the same example we referred to earlier as negative amortization. You have 4 payment options: negative AM, interest only, 30-year fixed, or 15-year fixed. You choose which one, but at a minimum it has to be this one. If you use this type of loan, you're going to be deferring interest and your principal balance is going to be growing, not shrinking. Hybrid mortgages, these were your old, again, your what you used to call 2-year fixed, 3-year fixed, 5-year fixed. Those were hybrid. Today, you have to call them an ARM. Anytime, any part at any time, your loan rate can change. You are required to call that an ARM. So today, you'd have a 2-year ARM, 3-year ARM, 5-year ARM, 7-year ARM, 10-year ARM. Now there's lots and lots and lots of other types of mortgage products. I'm just going to post them all up here, and we're going to go over kind of every one of them, but again, a lot of them we've already discussed. Balloon, 30 due in 15. You have to pay off the loan in full before the end of your amortized term. Biweekly mortgage, you make 26 payments in a year. If you're getting a biweekly mortgage or your borrower is, explain to them that means 1 payment every other week. It is not 2 payments a month, because if you have 52 weeks in a year and you're making a payment every other week, you're making 26 payments. So in a year, 2 times during that year, you're going to have to make 3 payments in the same month, and people better budget for that, otherwise they're going to get themselves behind. Blanket mortgage, I'll show you this one on the board. A blanket mortgage is when you have one loan that covers more than one parcel or more than one piece of property. You used to see these a lot more when you had construction loans, but we're going to show you what it looks like. These are also known as cross-collateralization loans, long word. So let's say you've got a contractor or a builder who buys several lots or one big lot and separates them or subdivides them. Okay, they build their house on one lot. Okay, once it's built, they sell it off. Okay, but they have one loan on all of those pieces of parcels or all those parcels. If they build a whole bunch of houses all at the same time, okay, and they keep them, it's still a blanket loan. It's one loan that covers multiple parcels or multiple properties all at the same time. And then what they do is often sell them off, and that's something that we'll discuss a little bit later in that selling off and what it's called. All right. Cash out mortgage, you're refinancing your home for the specific purpose of taking cash out of the equity. All right. Construction mortgage, you are building a home. This is not what you get when you are remodeling your home. That's a remodel, and you don't usually get loans for that unless it's a personal loan. Construction loan means you are building the property from the ground up, putting in the foundation. It's a brand new construction loan. All right. Equity participation mortgage is typically a commercial type of a loan, and this is where the lender can participate in the equity, meaning that for the trade-off of maybe having a lower interest rate or lower closing costs, the lender says, all right, we'll participate in the equity, which means either when the value of your home when the value of your property goes up, you're gonna pay us a certain percentage of that because we gave you lower or better terms to start out. Or if you are getting a high amount of rents, we're going to take a portion of that rent to cover what we gave you the loan for, or the discount or the better deal we gave you when you got the loan. So that's equity participation. Graduated payment buy down. You can pay more now at the close of the loan and get temporarily reduced interest rates. And you may be thinking, well, why wouldn't you just pay cost like we talked about before and get a lower rate for the entire term of the loan? Why would you want it to be temporary? Well, here's why. When you're doing a permanent buy down, or again, paying cost to get a lower interest rate, you get very small decreases in the rate. So let's say it was going to be 4%, and for a little bit more at closing, you can get 3.25, 3.75. A little bit more in cost, and you could get 3.5, and even more in cost, you can get 3.25, and so on and so forth. With a graduated payment buy down, it means that you pay more now for a pretty big reduction in the payment, or in the interest. So let's say you had 5% interest rate, you were doing a graduated payment buy down, so you pay an extra, I don't know, I'm making this up, $5,000 at closing, but for the first year, you're gonna get 3% lower on that rate. So for the first year of your loan, you're paying 2%. The next year, it's gonna graduate up to 3%. So the next year, year two, you're gonna pay 3%. The next year, you're gonna pay 4%. Then the next year, all the way to the end of the term, you're going to pay 5%. That would be a graduated payment buy down. It basically means you pay more now to get a significant reduction in your interest rate or your payments for the first few years, and it will gradually increase, hence the term graduated payment buy down. All right, next one is home equity loan or home equity line of credit. Very common sense, we've already talked about a lot of those. I think I have a typo here. It's I-home, but interest. So sorry, I have a typo in there. It should be interest only loans. That's where you're paying back the premium, or I'm sorry, you're paying back the loan, but interest only. So at the end of the term of your loan, you're gonna owe $300,000 if you borrowed $300,000, right? So interest only means you do not pay any principal during the term. Open-end mortgage would be that of an equity line. There's no end date to your equity line. It's just going to rise and fall as you charge it up and pay it back. Package mortgage is one that includes personal property. You don't see that very often at all in the lending industry today. Purchase money mortgage, exactly what it sounds like. You are getting this loan or this mortgage in order to buy a property or to purchase a home. Refinance, you've got a loan, rates have gone down, you want to keep your house, but you want to get a new loan to pay off the old loan. That's a refinance. Reverse mortgage, you have to be 62 years old or older to obtain one, and they're really meant for the elderly who are living on, Social Security or fixed incomes. So what this reverse mortgage does is if they've spent their whole lives paying down their mortgage and they have little or no loan, they can actually live on the equity in their home and, again, not have to worry about going back to work because they ran out of money or whatever. It allows you to live on the equity. And then there's, a wraparound loan. A wraparound loan is one where it's an unapproved assumption. So let's say, for example, Bank of America has your loan now. You're not able to sell your house, but you've got somebody else who wants to take over the loan for you. So that someone comes in with an agreement and says, I'm going to take over your loan, but we can't tell the lender because they have this clause, says it's called an alienation clause. We'll talk about that in just a minute. But it says if you transfer the title to your property, then we're going to call the note because we didn't give the loan to Joe Schmo over there. We gave the loan to you. So a wraparound loan is when someone comes in and takes over the payments and the terms of your loan, but there's no transfer in title title. So you're kind of wrapping somebody else into your loan, but it's not really an authorized transaction through the lender. All right. Terminology, acceleration clause. This allows the lender to call the entire note due and payable in the event of a default, or basically you stopped making your payments. Acceleration means they can accelerate. When you think about it, when you accelerate in your car, it means you go quickly, right? Well, we quickly want the entire amount paid off. That would be an acceleration clause. This is very common for mortgage states, not very common at all for deed of trust states. Alienation clause. Alienation clause is exactly what I was just referring to on that wraparound loan or wraparound mortgage. Alienation clause says that if you transfer title to any other person and you, the original title holder, is no longer on the loan, then we are going to call the note due and payable. We didn't give the loan to Joe Schmo. We gave the loan to Charmin Lane, so we're going to call the note because we don't know what their qualifying parameters were. So that would be an alienation clause. And then there's an assumption. An assumption is when, let's say, I want to sell my house, but values have gone down and I can't sell it, and I can't refinance it because I'm upside down. But I can get somebody else that wants to take over my loan for me because they've got longevity. They know this property is going to, gain over time, and they want to let me out of my side of the agreement. So somebody comes in and wants to assume my loan. We talk to the lender. They provide all the documentation, income and job income, and all the information on themselves, their income and their assets. And the bank says, okay, they're a good risk. We will allow that person to take over your loan. That's an assumption. All right, another term is a buy down. We actually already talked about that a little bit earlier. This again is where you are buying it down on a temporary basis, or you can do it permanently. Temporary buy downs are the ones where you're going to get a bigger drop in the rate in the payment, but it's going to be for a shorter period of time. Permanent buy down brings down the rate of the payment a little bit, but it's going to last the entire term of the loan. Discount points. This is where you pay more now to get a lower rate or payment later. All right, that's when you are paying discount points. It's also called cost or a buy down. All right, 1 point is 1% of the loan, and again, we also call it a buy down. The buy down can be paid by anybody. If I'm doing a loan and it's FHA, and FHA allows for 6% of the closing costs to be paid by the seller, but all my closing costs only total 4%. You bet your bottom dollar I'm going to do a buy down because I may as well get the benefit of a lower interest rate for the whole life of my loan because the seller is willing to pay for it. I'm going to make sure I maximize all 6% that they were willing to pay for. All right, graduated payment buy down. This is the example I was telling you before. The first year you should have been at 8.75, but now you're really only going to be at 5.75. The second year you're going to bump up a little bit. You're going to go to 6.75. The third year and on you're going to be, the third year you're going to be at 7.75, and then the fourth year moving forward you will be at the 8.75. That is a graduated payment buy down. All right, defeasance clause. This is something that occurs during the time that you have your loan that you do that cancels or defeats the purpose or the concept of the loan. So let's say most commonly it's going to be something like you agree to keep your taxes and your insurance current. You let your taxes lapse. If the taxes are not paid, the city or the county or the state can sell your house and they sell it for the amount owed on the taxes and the bank gets nothing. All that extra goes to the borrower if there was anything left over. So when it comes to a defeasance clause, lenders are going to want to make sure that you keep your taxes current. And if you don't, then the lender can file default on you. Okay, they'll probably bring the taxes current so that they can sell the property and you just lost your home. That would be a defeasance clause. You did something that you weren't supposed to do, or you didn't do what you were supposed to do, and they say, that defeats our loan, and we're going to exercise our defeasance clause. All right, partial release, satisfaction, or conveyance clause. That's what I was talking about on blanket loans, blanket mortgages. When you've got one loan that covers more than one piece of property or more than one parcel of land. In that example over here on the board where we have one loan that covers all these properties, with each one that they sell off, they're going to get partial release. They've satisfied this portion of the loan. So if the loan was $100,000 and it's broken into, what is that, 1, 2, 3, 4, 5, 15 parcels, whatever that math would be, you're going to sell off that one parcel or that one house. You're going to pay off that portion of the loan, 1/15 of the loan, and you're going to still be responsible for the other 14 pieces, okay? So that is called partial release. You're released from one piece of the obligation, but not from the entire obligation. Subordination clause. This is where you are getting a new first mortgage even though you already have an existing second mortgage. So let's say you do a first and second mortgage. You've got a first mortgage with Bank of America and your second mortgage with Wells Fargo. Well, first mortgage rates have really declined. You used to have a 6% and now you can get a 3%. So you want to refinance that first mortgage. Well, the second you pay off that first mortgage, second slides into first because it's done by date. But if you have a second, that Wells Fargo that's willing to stay in second position, and say Chase Mortgage is going to take over the first position, the second has to subordinate. We agree to stay in second position behind a new first mortgage. That's a subordination clause. All right. We talked earlier about Community Reinvestment Act. It does exactly what it sounds like. It requires lenders with physical locations to reinvest back into the community. So if I have a property, I'm trying to think of like a really low income area. I'm from California originally, so let's say it was like South Central Los Angeles, okay? Kind of a low impoverished area. And I want to open up a bank or a mortgage company or something like that in that city, in South Central Los Angeles. But I don't want to lend to the people in South Central Los Angeles because they don't have any money, right? So I'm going to put my branch here and I'm going to collect people's money for deposits and checking accounts and savings accounts and credit cards and things like that. But I'm not going to lend to those people. Well, that's where the Community Reinvestment Act comes into effect. You can't have a physical location and not lend to the people in that area as well. So that's what Community Reinvestment Act does. All right. FHLMC, which again is Freddie Mac, that stands for Federal Home Loan Mortgage Corporation. They're one of our major secondary market players today, along with Fannie Mae, which is Federal National Mortgage Association. They are both under the Federal Housing Finance Agency, okay, FHFA over here. All right, these are government agencies with regulatory authority over Fannie Mae and Freddie Mac. That's Fannie Mae, which we just said a moment ago, Federal National Mortgage Association. It was created in 1938 during the Depression, and it was Franklin Roosevelt who said, why don't we create this organization that buys loans so that these banks can continue to lend to people? Because once the banks ran out of money and had no more assets or collateral that they could lend, or they had no money left to lend, they wouldn't be able to lend anymore. So if they could do a loan for somebody, sell that loan to Fannie Mae, Fannie Mae gives them the money for that loan, probably plus a little bit of the profit. That gives the bank back their money so they can continue to lend it out again and again and again. And that helped the economy get going again and allowed us to get out of the Depression. Of course, it took a long time, but it was a system that actually worked. All right, they purchase conventional mortgages as well as FHA and VA loans as long as they fit their requirements. Again, Fannie and Freddie are both under the conservatorship of the Federal Housing Finance Agency. Foreclosure. Foreclosure is always, that's a bad F word, let me tell you. Foreclosure is where the lender can take back the property and no longer accept payments and say, you either bring your loan current or you have to pay your entire loan off because you no longer have made payments. Now, if you are in a if you are in a judicial foreclosure state, it means that the lender can accelerate the note and call the whole thing due and payable, even if you were only behind one payment. That's because that mortgage has what's called a judicial foreclosure, and it has a clause in there that says if you miss so much as one payment, we can call the whole note due and payable. We don't want your one payment anymore. We want the entire balance due, and we're going to initiate a judicial foreclosure, which means we have to file a lawsuit and show our documents that you really are in default, and we can call the entire loan due, and we take the house back. All right. Now, other states have non-judicial foreclosures. Depending on where you are is going to depend on what type of foreclosure your companies are going to end up doing. With a regular non-judicial foreclosure, you only have to bring what the past due amount is up to date in order to keep the house. In a judicial mortgage state, or in a mortgage state which usually uses judicial foreclosures, then they want the entire balance due. They don't want to mess around with your little silly payments anymore. Non-judicial, just bring your loan current. All your past due amounts that are due, bring them current, and you get to keep the house. All right, so regular foreclosure or a mortgage foreclosure, the lender will actually file a lawsuit, and they could do what's called a deed in lieu of foreclosure, which means they're going to kind of have they're going to overwrite the agreement and allow you to stay in the house based on this deed instead of a foreclosure. That actually wasn't a really great explanation. A deed in lieu of foreclosure, a better way of saying this is, instead of foreclosing on me and having that foreclosure on my record, what I'd rather do is sign my property over to you, Mr. Lender. You just take the house back. I don't want anything for it. I just want to get out of my loan. That's a deed in lieu of foreclosure, or a deed instead of foreclosure. The other item I just explained was actually called a forbearance agreement. So my apologies for the confusion on that one.